Investors often focus a lot on the income statement and balance sheet when analyzing companies. But the third member of the financial document trifecta can be just as important: the cash flow statement. A cash flow statement summarizes the cash entering and leaving a company during the reporting period. This includes cash equivalents that can be liquidated within a short period of time, like treasury bills, money market paper, and short-term guaranteed investment certificates, or GICs. The cash flow statement explains to investors where and how a company is spending its money. This can help them understand how a company operates and give them clues about its financial health. There are three main components to a cash flow statement. First, cash from operating activities. This includes any cash transactions that relate to the production and sale of a good or service, like sales receipts, purchases from suppliers, rent, and employee wages. Usually, it does not include purchases or sales made on credit, since no actual cash changes hands at that moment in time. Next up is cash from investing activities. This includes any cash transaction that changed the value of a company's assets or investments. That could be the purchase or sale of property, equipment, and even other companies. The last section is cash from financing activities. This includes all cash transactions related to the company's debt or equity, like issuing stock, taking out a loan, or dividend payments to shareholders. Okay, that's a quick rundown of each part of a cash flow statement. Now, let's look at an example from our fictitious chocolate maker and break down what we can learn from each. Starting with cash flow from operations. Investors might consider asking questions like, what is the company's biggest expense? Will that change as it grows? How do these numbers compare to previous periods? How do these numbers compare to competitors? Our chocolate maker's biggest expense is buying supplies to make chocolate bars. The next is employee wages. It makes sense that these numbers would also increase as the company grows. However, it would be a problem if these expenses grew faster than sales. One way to track this is by converting each expense into a percentage of sales. This also makes it easier to compare cash flow statements across different time periods and to those of competitors. The next section is cash flow from investing. The most common investments are in plant, property, or equipment. Making investments like this often result in negative cash flow from investing. Investors may see this as a bad thing, but it doesn't need to be. For instance, our chocolate maker could use the new equipment to produce more chocolate and boost sales. Or they could buy a plant so they wouldn't have to pay rent anymore. This would reduce operating costs. All that to say, it's important to understand the reasons behind a purchase and how it may impact the business in the future. Positive cash flows in this section would also be the result of selling previous investments. Moving on to cash flow from financing. When analyzing this section, investors may gain insights into how the company raises funds. Did they sell shares of the company? If so, do they pay shareholders a dividend? Or did they take out a loan like our chocolate maker did? How quickly a company pays off its debts can give investors clues about its financial health and the effectiveness of its management. That brings us to the end of the cash flow statement, or the bottom line, as they say. In general, investors assume a positive cash flow is a good thing, and in most cases, that's true. However, there may be opportunities to use that cash more effectively. Our chocolate company could repay more of its bank loan to reduce interest charges. Or it could hire more staff or buy more equipment so it can grow faster. Similarly, a negative cash flow for a short period of time may not be so bad either. For example, let's say the chocolate maker bought a production plant for $200,000. This would give them a negative cash flow of $190,000 for that month, the cost of the facility minus its net cash flow. However, this would also increase their cash flow by $10,000 a month because they wouldn't have to pay rent any longer. So, those are just a few things investors can learn from a cash flow statement. Remember, it's important to look over the income statement and balance sheet as well to see the whole picture. If you aren't sure how to read them, you can watch our lessons to help get up to speed.